And as you can see, I have on the screen here, which I have for a while, Carnival Cruise Line, CCL. Stock has really traded in, for the last short while here, but the last 2 months in this channel, really between the 50 and the 200 day, made a huge recovery off of the December massacre. If anything, I'm actually thinking that there's a very bearish channel here. Lower highs, lower lows. Peter, not sure if that's what you were looking at as well, but if you look at these data points here, there's really lower lows, lower highs. And even if we go all the way back to, a year ago, it's really been a pattern, lower lows, lower highs. So I'm not saying that we're going to do something bearish here, but that's kind of what I'm seeing. I agree. This 200-day moving average is definite resistance, big time resistance. So let's see what the market's anticipating here. Okay, stock is 56.54. Okay, so stock is 56.50. Expected move is what? And this is great. We've got $0.50 wide strikes. Makes our job really easy. So what's the expected move here? Yeah, Peter, you're pretty close. I'd say right about $2.80. Okay, if we just look right at the 56.5 straddle, that's kind of where we're at, $2.80. Bob, how you coming up with 235? Let's just make sure we're on the same page here. Okay, I'm looking at the straddle here. And if I look also in Thinkorswim, you can see in Thinkorswim, the one-day market maker move is about $2.63, and the move for the week is $2.86, and we came up with 280, so I think we're looking pretty good here. Okay, so expected move, whoops. It's about 280, gives us an expected range of 53.70 up to 59.30. Okay, going back to our chart here. Okay, 53.70, 59.30. Okay, well, on the downside, the only kind of support I see is back from October, which is right around 53.5. And the upside, again, this 200-day moving average, which is just above at 58.20, is going to be some pretty big resistance. Okay, so let's look at an iron condor just because we should, to see if options are priced appropriately to the expected move. So 53.70 and 59.30. So we might want to do something like that and that. And I'm not going to like that. So the 54, 53 and 59.60 iron condor is 37 cents. Gives us break evens, which are not bad compared to the expected move, of 53.63 and 59.37. Okay, those are great. Those are great. But however, at 37 cents, exactly what Alan just said, very, very low reward to risk. If this thing was trading closer to 45 or 50 cents, I'd probably be all over it. Now, let's see what happens if we skew this towards being a bearish iron condor. Okay, now, what if we could get 50 cents for this thing? Let me put this up on the board. So the 53 half, 52 half. So I lowered the downside a little bit, but I also lowered the upside. Let's say we could get 50 cents for that. Okay, now our break evens are 53 up to 58 and a half. So in terms of the downside, obviously gives us a lot of room. Upside, we're short. But we would be intentionally doing this to have a short bias to it. Right? Okay, so that's one option, no pun intended. Now, let's look at a straight vertical. Okay, if we're targeting 53.70, the 55 half, 53 half put spread, 60 cents. That's a little too rich for our blood from a reward to risk standpoint. Because our reward to risk especially for a directional earnings play, is only 2.33 to 1. However, the 55-53 half is 40 cents. Reward to risk on that is much better at 2.75 to 1. Okay, so if we were going to do a straight directional, I'd much rather do that put spread. Now, let's also look, see what volatility is doing, and let's look at a calendar put spread. Okay, the 53 and a half put calendar probably costs us 12 cents or so. This is a 1 week put calendar. And that's okay. I wouldn't say that's great. That's okay. What if we went out to not 1 week, but if we went out to regular April expiration on that? Okay, that's about 28 cents maybe. little better, but I don't love the calendar. Okay, so put calendars are just so-so. We could look at a diagonal. Or something I like right here that I'm just noticing as we speak, going out to regular April. Just a plain vertical 55-53 put spread. Let's say we could buy that even for 55 cents. $2.64 to 1. Which leg is that, Paul? Just the strikes that I chose? Oh, the later April? I was just looking at the volatility and buying us some more time. Usually, as we know, the more time we buy, on a calendar or something, the more it costs us. Well, here it didn't look so bad by buying us more time. Okay, one last thing I want to look at is a diagonal. So selling this week's and buying a higher strike put going out next week or even going out to later in April. So this is the 53 half, 54 half. Cost us about 40 cents. Now this looks pretty decent. That looks pretty decent. What do you guys all think of that? So this is a diagonal, the March 29th, April 5th, 53 and a half, 54 and a half diagonal put spread, which would cost us about try and get it for 35 cents. That I like, guys. So, based on what we have up on the board, I would look at one of two things. Either of these. So either just a straight directional here this week, or the diagonal. Okay, what do you think? So, Michael, it's a little bit more difficult on a diagonal or on a calendar, but let me put up the risk chart on the diagonal. So here's what I see. I like it. I like the diagonal. Because even if we get to, folks, even if we get to the expected range, 53.70, that puts us right about in here and gives us a nice bump over our 35-cent investment. You know, this probably has a value of 45, 46 cents. I'm going to put that out there, guys. I really like this diagonal. Peter, are you good with that since you're the one that brought us up on this, even though we had Carnival on the board? Well, that too, Jerry. It's like a calendar. Um, it does give us an opportunity to reevaluate, to roll. So I like this. All right, any questions, anybody? Otherwise, I am going to get this signal out there. Nope. Okay. Let me wrap up the video here, get that posted, and get the signal out, everybody. Okay. I'll be right back.